our response, like medically and historically from a health perspective, our response has always been to treat the patients who get sick. But that's not what we did during the pandemic. We actually killed the economy.
All right. Well, welcome back, everyone, to another RLT PIVOT Podcast. My name is Tracy, and I am joined again with my co-host, Dan Jansen. We have a special guest with us as well. Dan, how's it going? Who's our guest?
Doing absolutely fantastic. And you said before we started recording, I'm itching to start this conversation because I love talking about the markets and general history of the markets and financial economy, things like that. So we got Addison Wiggin with us today. He's got his own podcast. He's been in the financial game for, I believe, 3 decades, but I don't want to talk for him. So Addison, how are you?
I'm doing great. I'm just going to do a selfless plug right at the beginning. I just published this book. I'm really happy about it. It's the 3rd edition of Demise of the Dollar. I've been studying historical trends in the market for 30 years. So I'm happy to be here and talk about it, and also happy to talk about some of my findings.
You also produced the documentary I.O.USA. Is that correct?
I did, and that was a challenging project in and of itself because I had worked on a book called Empire of Debt with Bill Bonner, and then the book ended up being like 455 pages long, I think was the final count. And I'm like, it's like next to impossible to get people to read. So I was interested. I actually, while doing the research for I.O.USA, I stumbled upon Commanding Heights, which was written by Daniel Jurgen. It was a book, but then it was also made into a documentary. And I got snowed in Vermont at my brother's condo, and I watched. It was a PBS produced documentary that lasted, I think it was 8 hours long. I watched it like 3 times.
Wow.
But I was like, oh man, all of the research that he put into that book, and then what I was trying to do at the same time, I'm like, it's so much easier to get people to watch video than it is to hand them, an economic tome and expect them to actually read it.
Yeah.
So we produced that. That took like 3 years to actually produce the documentary too.
Wow.
There's a lot of backstory on that one also, but
cool.
We don't have to go into that right now.
What would you rather do from your perspective? Write a book or produce a show?
Well, they're just kind of different things for me. I like writing books or even doing the daily email, which I also do, because I can just sort of follow what I'm interested in. I'm mostly interested in like historical trends and how they play out in the market. So I'm always trying to match what I see happening with what what the Fed's doing or with what traders are doing. I'm fascinated by some of the big hedge fund traders because they're often making trades that are counterintuitive, but then they're also following trends. So I'm really interested in that. Video is a little bit of a different beast because it's a production. When I'm doing research or writing for the books, it's my own time. Right now I'm talking to you from a self-made studio in my basement, and I can like pace around and do all kinds of things that you never get to see on video.
And I would say being a historian really of the market and financial situations, we're in and probably living in history right now where 10 years from now, people are going to go back and be like studying kind of what happened with the Fed's doing, what the rate hikes are doing, how COVID kind of affected everything and supply chain issues, all that stuff. Is there a period in time, because I've read reports, I've seen videos, I've seen everything where there's always somebody comparing this time to the 1987 crash, the 1962 crash, the housing crash of 08, there's always something that people want to kind of go back on, lean on. Do you think right now in U.S. economy, we're seeing anything similar to anything you've seen before in the past?
Not really, because I think we entered into an unprecedented period when when they locked down the economy during the pandemic. Like our response, like medically and historically from a health perspective, our response has always been to treat the patients who get sick. But that's not what we did during the pandemic. We actually killed the economy. We shut everything down. And I think the knock-on effect of that, it hasn't happened before. So we don't really know what the lasting effect is going to be. The closest period that we could probably compare that to would be the influenza outbreak in 1920, but we didn't lock down the entire economy. We were afraid of a pandemic, and maybe rightfully so. Maybe COVID was that big of a deal, but we've never seen the economy get shut down in that way. And then the response was to say, okay, we shut down the economy. We're going to give you money. And so they injected a lot of money directly into middle class pockets, mostly some working class, but mostly middle class. And then the effect of that led directly to inflation, but it was built on top of whatever it was, 8 years of zero interest rate, like a lot of speculation that was driven by cheap money in the markets. So they kind of just poured gas on the fire. There's no comparable period in history that led to the kind of inflation that we just saw. A lot of people want to talk about like 79 through 83, Paul Volcker. I met Paul Volcker and he's like, yeah, once inflation gets out of control, it's hard to contain. Ben Bernanke was a student of the 29 through 33 period and was a advocate of zero interest rate policy for a long time. So I've read a lot about all of these different periods, but the one that we're in now is still unprecedented in my opinion. But that's always true, isn't it? Like when we're studying markets, there's never a direct comparison to some earlier time. And like I've been doing this for a while, 30 years, and we could see the writing on the wall before 2008. Nobody cared at the time until Lehman Brothers went bankrupt. And we were actually doing you brought up I.O.USA. We had written a book and then we were doing the documentary leading up to that. We actually premiered I.O.USA on August 22nd, 2008, 6 weeks before Lehman Brothers went bankrupt. And I was using government numbers at the time because I didn't want to be cast as a gloom and doomer or something. I was just saying, look, this is what we're doing. We're raising this debt level. And I was paranoid at the time that we were about to go over $10 trillion. We went over $11 trillion before the end of the fiscal year that year, which was only 7 weeks after we premiered the film. And then we went, by the time Obama became president on January 22nd or 20th of the following year, we had racked up another trillion. Like the rate at which we're racking up debt was already astounding in 2008, 2009. And now I'm sort of at the period, the point where I'm like, what are we doing? Like, why do we think this is a sustainable trend? And we don't have the political will or structure to rein it in. So I think we're in unprecedented times because there is not a comparable time where we're willing to spend money at the rate that we're spending it without any justifiable, well, I guess if you believe the MMT people, the modern monetary theory people, that we could just spend it as long as we can take it back in taxes later. But this is insane, in my opinion. But you still have to make financial decisions on your own, and that, like on programs like yours, and what I try to do in my own podcast, is I try to like make sense of it enough so that people can make decisions about how they're going to finance whatever they need to, like tuition or healthcare
Yeah.
or invest for the future. Like what do people want to do? They want to retire, or what? There's a lot of decisions you have to make in your
Depends on
life.
the stage of life, right?
Yeah, and so it becomes difficult to have the conversation if the macro picture is as crazy as it is now.
Yeah. What do you recommend or suggest to people that they need to consider or think about when they're trying to plan for scenarios like that? What should they be looking at? What should they be considering and planning for so they can make informed decisions?
Yeah, so it goes from the macro picture. I think the macro picture is one way of looking at the markets, because there are these historical trends that are in place, and we're in unprecedented territory, like I was describing. But at the same time, there's micro things that you can do, like money markets are good right now if you're trying to just save your money. Like when the Fed started raising rates, money markets started paying off dividends, or just even returns on like 30 days and stuff like that we hadn't seen in 20 years. Like, there are ways of moving your money around right now. One of my favorite ones is, and I think it's kind of controversial because I've talked to a few people about it, but we work with this group called the Hard Asset Alliance. And you can open your own account and invest in gold, like actual bullion, not coins or anything, silver, platinum. And most of those markets, in my opinion, are manipulated, but that means that they don't go up and they don't go down. They kind of hold their value. So you can dollar cost average yourself into like what I would consider a hard asset alliance savings account that's based in gold. And then if you want to, do something crazy like trade options or invest in NVIDIA, that's one thing that I was talking about earlier this year. When you get the momentum trades, you can take your money out of those accounts, and then you're speculating with that money. But in the meantime, you can kind of save it in what are reasonably stable accounts at Hard Asset Alliance. That's one of my favorite kind of trades right now. Another one that I do like is, and this is just something I've been following since the early 2000s, the Bank of Japan has continued to keep rates low, and they just even made another announcement in the middle of July where they're like, we're not going to raise rates anytime soon. So you can borrow money in Japan still at a very cheap rate and then use it. You can put it in a money market account in the US, and you can make like 4 or 5% just because the rate differential. They used to call it the carry trade, but I don't know. There are like smart things that you can do because, and going back to the historical perspective of the way I see things, most of the central banks of the world are just trying to manage fiat currencies. And there's no backing, like since 1971, there's been no backing for the US dollar. The euro is like, we used to call it the Esperanto currency. It was just made up out of nothing. Japan is what it is. The yuan is what it is. Like, everyone's trying to manage a fiat currency, which basically just means the governments decide what the policy is that supports them. So there are interesting things that you can do, but you kind of have to pay attention. It's not just invest in gold or buy tech stocks or trade options on I don't know, commodities or whatever. There's a lot of things that we can recommend, but there's no simple answer. You have to pay attention because the currency and credit markets are in a high degree of flux right now.
Yeah. And usually and I think you have to be an avid watcher of the different markets, because usually once you hear like, here's the opportunity, it's probably pretty late. Like I know you said invest into tech and stuff, which was a great trade and great opportunity for a lot of
like
people.
9 months ago.
But I'm getting calls from people now like, hey, should I get into I'm like, probably not. I don't know.
Yeah.
I wouldn't even do that with my money, so I don't know. But yeah, so I think it's different. But and I know we've seen numbers from the federal government they put out where we have I think there was a report that says most Americans can't probably won't be able to cover like a $400 emergency bill.
Yeah, that was last week.
That was last week. They just put that out. I've seen other ones where our debt is not at the all-time high, but we're creeping up for individual debt. So not even talking like, the government chaotic spending, we're just talking individuals, some of their debts increasing. So we're seeing a lot lower savings. We're seeing a higher debt. And right now, I think we're still seeing semi tight restricted lending from some of the banks in general. So what I was looking at for some opportunity, I was actually talking about this 2 days ago, something like that on the mic. But with the rates the way they're at, and probably I think Jerome Powell might be toward the end of his raising or pausing at least for a little bit, slowing down in worst case. I think that might be a green flag to the banks to start being able to put some of this more money out into the economy, start lending and start easing back on the restrictive lending. So my theory is on this is if that happens, I think that's going to be another avenue for individual people to start to go in for whether they're businesses, whether for the personal loans, whatever it is, try to take advantage of that. That adds more debt, and that pushes up the credit ratio to income from a lot of people. And that could be something that I think could tumble in 2 to 3 years, because it's going to take a while to really build up the debt where it's just drowning people. So I think we have a real debt crisis that is still kind of bubbling a little bit.
Right. I would agree with that. I have a couple of different opinions on that. When the pandemic hit, the savings rates actually increased higher than credit, personal credit, like loans and credit card and whatever, mortgages and stuff like that. It actually spiked beyond that. Part of that was just stimulus money that was sent out to people. But then when the economy started opening back up, that savings rate dropped to at the fastest pace that it's dropped since 1933, since we had a real credit crisis. And that at the same time, personal credit, so loans and credit cards and those things, spiked even higher. So you had a drop in savings rate and you had a huge increase in personal credit. And then the Fed started raising rates. So there is a squeeze that's happening where it's not a headline story yet, but it will be. And my guess is it will manifest itself in the earnings season in late September or whatever, when S&P 500 companies that are mostly dependent on consumer spending are going to start revealing that their single store revenues are dropping. I think that's what we're going to see next. The last time we saw this was in 2008, or started in 2006, but it really kind of peaked in 2008, when everyone was talking about balance sheet recession among major corporations. And I think we're going to see that again, because all the indicators are that the consumer is tapping themselves out. They're kind of excited that they can go out and spend money again because the economy's open. We were watching things like Charles Schwab and Carnival cruise lines because people were just spending tons of money because they could again.
Yeah.
And so those stocks
miss doing anything. Yeah, exactly.
But
well, so I agree with you with the I think we get back to the balance sheets, and I think that becomes a big talking point. I would say I would debate the time frame, because I think with if regional banks, if regular banks, they start to open up the flow of lending a little bit more, I think that actually helps to falsely sustain a lot of the balance sheets for a little bit further. That's why I think, because now if people are able to get money, companies are able to get money, able to reinvest, kind of grow it. I think that's good for the underlying business. So I agree with what I think you're saying. I think this whole thing gets pushed back a little bit further than we were expecting, though.
Yeah, it's possible.
Yeah.
But I think there's an important distinction, because I've been watching this banking thing for as long as we all have. But
you probably even longer than most people. So
well, there's a distinction to be made between being an investor in banks, like looking at the underlying value of the banks, and what the banks reflect about the consumer. I mean, we're like 78% of the economy is driven by consumer spending. Like, the banks also reflect the underlying health of the economy. So there's a distinction that I think is important to make, is you can invest in banks because banks make money, and you can be excited about that. But they also reflect the underlying health of the economy. And I think that those are the numbers that are leading indicators for what we can expect I think in the fall. Maybe my time frame is a little shorter than yours, but certainly in 2024, a lot of these things are going to come home to roost. And then what do? Then the Fed has to get involved again. Like, the game just keeps going on. But,
yeah, I 100% agree.
Yeah, I'm curious. You did bring up 2008, and you said some of the relations that had to do with that. But I guess what I'm curious about, because I've been feeling like this since the beginning of COVID, with all the stimulus checks and the way the government's been printing money and giving it to people. I've felt like, there's got to be a shoe that drops at some point. There's got to be some kind of check and balance that balances this whole scenario out. And I haven't seen the cautiousness or the concern from individuals that I think is warranted. And what I'm curious about is, it feels very much like 2008, when people were almost in denial of all the stuff that was going to happen. And it's like the real estate crash, the market crash, all of that was a shock. It's like, except to a select few. And do you think that the powers to be have actually learned any lessons from 2008 and are taking them, or are they just completely oblivious to any of the lessons that you could have learned from the past?
Yeah, I think it's really hard to say that they're oblivious to anything, because they're smart people.
Yeah,
they read the same books that you and I have. They've studied the markets, and they've learned how to deal with different financial crises. The strategy that they're putting in place is usually, right now we're not going through that, but is to just drop interest rates so that consumers feel confident that they have control over whatever crisis is happening. And I've actually just put out a piece where, if you start in 1987 and you look at 1987, 1994, 1998, 2001, 2008, 2011, which was a kind of an anomaly, 2015, 2018. But the response to every crisis has been the same since Alan Greenspan sort of chartered the way that the Federal Reserve responds to crises. Right now, we're in a crisis of inflation that was born of low interest rates for a long period of time. But when the next crises happen, the thing that like let's call it a balance sheet recession again, when that starts hitting the S&P 500 again, the response is going to be the same. Like, the ideology of the Fed is that low interest rates will paper over any of the crises that we have, and I think we're going to see that again. What is the end game of all that? It's that's what my book's about. It's the demise of the dollar. Every time they do that, we lose value in what our currency can actually purchase and how we manage our own lives. So I just, in a way, I'm sort of agreeing with you, but I think it's more complex than that, because I don't think they're not dumb people. It's not like they are missing the puzzle. They're just solving it in a way that it behooves all of us to understand the economic philosophy that they have and what they're doing, because it does mean that over time our fiat currency loses value, and you have to figure out how to manage that in your own life.
Do you think that the response that you just finished saying is what they do every time? Do you think it's the right thing to do? Like, if you had choice, I know this is hypothetical because it's not your decision, but hypothetically speaking, based on your experience and your knowledge, is there an alternate response solution that you think might be more conducive to a better recovery and maybe even prevention from this happening in the future?
I think my answer would be more philosophical than anything else,
Okay.
because we live in the world that we live in, and they're making decisions that they are making. And even if you don't agree with them, like, for example, when they publish employment numbers or CPI or whatever, you can disagree with them, but those are the numbers that actually move the market. So it makes sense for us to all understand their philosophy on how things impact the market. Like I disagree with the way they report CPI, and which is their measure of price inflation for consumers. I don't think they calculate it properly, but it doesn't matter what I think, right? Because when the CPI is published, it does move the market, and there are a bunch of traders out there who get excited about it and move one way or another. So it doesn't really matter what I think is kind of what I'm saying, is that you have to understand the different trends that are in place and the philosophy behind how they make decisions on raising interest rates or whatever. This sounds like a complicated answer, but it's really not. It is what it is kind of what I'm saying. I think that all of that would go away if we still had some kind of hard currency behind any one of the major currencies of the world. So if the U.S. was still on the Bretton Woods system, where the other governments could hold check on government spending for the U.S. just by redeeming their dollars for gold, I think that would put a check on the system. We don't have a check on the system. We don't have a check on the system for the dollar. We don't have a check on the system for any kind of credit that gets ushered into the banking system. There's no check on the system for decisions made at European Central Bank or Bank of Japan, China. Like, they're all kind of managing perception of what the value of the currencies are. And the most important thing is just to understand that that's what's happening. And when you make decisions for your own finances, you have to be aware that it's not a stable system at all. It's political.
So given that, the demise of the dollar, do you feel like cryptocurrency, possibly even the gold back, those might be solutions that would step in front and be a little bit more stable in the future?